Okay, so let's start. We want to start a new topic now. And our topic is accounting for deferred tax. That's our topic. So let me introduce it. Let me introduce this topic, accounting for deferred tax. Now listen. As at this level, you must have done the topic or the subject called taxation. You all know that when you as a businessman, you compute your accounting profit. Whatever is your accounting profit, if you present that profit to the tax income authority, they normally don't tax you on that profit. Whatever profit you have computed in your income statement, let us assume it is 800,000. That's the profit. When you give the taxman that profit to tax you, you all know that he will not tax you on that 800. What the taxman will do is to calculate what we call the taxable profit. According to the taxman, how much should you pay tax on? That profit on which you should pay tax on is what we call the taxable profit. He will calculate and tell you how much you should pay. So we are saying normally that the accounting profit is normally not the same as the taxable profit because of the rules that you as a businessman you use when you are preparing your income statement and the rules of taxation. Okay, now let's continue. You also know to compute this taxable profit, we normally take the accounting profit and you have to add all the disallowable expenses. You have done taxation before, you know how to compute the taxable profit. You normally take whichever is the accounting profit and add the disallowable expenses. Once you identify the disallowable expenses, of course I hope you know some, you will normally get the net of all of them. Then you come and less what we call allowable expenses. You minus what we call allowable expenses, whatever they are. Once you minus the allowable expenses, whatever they are, that leaves you with the amount on which tax should be based on for tax purposes. The profit on which tax should be based on for tax purposes. So that's generally how we normally compute. The taxable profit. We normally take the accounting profit, you add all the disallowable expenses, whichever they are, and you minus the allowable expenses. Let me give you an example of a disallowable expense. Listen, as a business, when you are preparing your accounting profit, when you are preparing your income statement, there is an expense you could have used in your income statement, which for tax purposes, the income tax authority does not recognize it as an expense. For example, you know, depreciation. If you depreciated one of your assets, you must have debited your profit and loss with that amount of depreciation. But for tax purposes, the taxman does not recognize depreciation. According to him, it should not be considered as an expense. So how will the taxman argue? He will argue by saying, by you recognizing an expense called depreciation in your income statement, listen, as per the income tax authority, your profit is wrong. How? Because your expenses are overcasted. And when expenses are overcasted, of course, profit is undercasted. When expenses are overcasted, profit is normally undercasted. So that's why we take the profit, add back the disallowable. I've given you one of them called depreciation. The taxman does not recognize the depreciation charge for the year. That's one. Another example of a disallowable expense is what we call provisions for bad debts. Provisions for bad debts. We call them the general provisions. You all know that general provisions are normally not recognized for tax purposes until general provisions for bad debts are not recognized for tax purposes until the loss becomes specific. But when you as a businessman, you anticipated, listen, when you anticipated that some of your debtors are likely not to pay you, you provided, you made a provision which is agreeable according to the rule of prudency concept, which says when you anticipate a loss, provide for that loss. So from the accounting point of view, you are right when you made that provision. When you anticipate to make a loss, you make that provision. So if you as a businessman, you provided for bad debts, that's okay. But from the income tax authority, they don't recognize that general provision. Until when? Until when the loss becomes specific. So to the income tax, your expenses again are wrong. According to them, your expenses are wrong. They are saying your expenses are more than they should be. Your expenses are more than they should be. So when expenses are overcasted, again, profit is undercasted. So another example of disallowable expenses is what we call provisions for bad debts. Provisions for bad debts. That is not recognized for tax purposes as an expense. Another one you know is donations. For example, donations. When you give a donation to a political party, you as a company, when you give a donation to a political party, that donation will not be recognized for tax purposes. So you could have recognized it as an expense in the income statement, but for tax purposes, it's not recognized for tax purposes. Good. Therefore, from the taxman's point of view, he will argue again. You have depreciated your asset. You have given a donation. You have recognized it as an expense in the income statement. According to the taxman, you should not recognize it. You should not recognize it. So again, he will argue by saying your expenses are wrong. They are overcasted. When expenses are overcasted, profit is undercasted. So to compute the true profit according to the taxman, you will come and add back that donation. You will add back that donation. Okay? Now, an example of allowable expense. An example of allowable expense is, you all know by now that as much as the taxman does not recognize depreciation, he also recognizes what we call capital allowance. So every time you are depreciating an asset like machinery, motor vehicle, and so on, yes, you as the businessman, you recognize that depreciation. But for tax purposes, they don't recognize depreciation. What they recognize is called capital allowance. Maybe you have been depreciating your asset at 20% per annum. Whatever it is, let's assume you bought a machine that costed you 1 million. Your policy is to depreciate it over its useful life, maybe 5 years. So if you bought a machine at a cost of 1 million and your useful life is 5 years and you're using straight line method, then it means every year you're depreciating your asset by 200,000. But for tax purposes, the taxman could give you a capital allowance at the rate of 25% per annum. So while you are depreciating your asset by 200,000, for tax purposes, it gives you a capital allowance of 250,000. Now listen. So this is how the taxman will argue, by saying you should have recognized in your income statement there is something you have not recognized which you should have recognized. And what is it? He is arguing by saying you should have recognized an expense called capital allowance. And because you have not recognized, then automatically, listen, automatically therefore, your expenses are undercasted. Your expenses are undercasted. And you know, when expenses are undercasted, automatically profit will be overcasted. When expenses are undercasted, profit is overcasted. So to correct that from the taxman's point of view, you will come and minus what we are now calling capital allowance, or what you normally call wear and tear allowance. Good. So I hope you are now getting the general overview of how to compute what we are calling the taxable profit. I have told you, accounting profit is that profit which is based on the normal accounting principles and concepts. Accounting profit is that profit which is based on the normal accounting principles and concepts. That means the profit that is normally reported to the shareholders. Taxable profit is that profit which is that profit on which tax will be based on for tax purposes. That profit on which tax will be based on for tax purposes, that's what we are calling the taxable profit. Okay. Before we continue, let me explain something. Before we continue, today we have 1 or 2 new students, and also some students are joining us for free. So for those who have joined us, listen, if you have not subscribed, please, if you have not subscribed to my YouTube channel, please subscribe. As you are watching this video, you could be seeing a subscription button there. Please, if you have not subscribed to my YouTube channel, please subscribe, so that next time, I'm especially talking to those who have not joined us for the normal classes, so that next time you will be notified of any new videos that will be posted in the YouTube. Any new video for free that will be posted. So if you have not subscribed, please subscribe by clicking that subscription button. Good. Now, some of you, again, listen, some of you are new and they have not joined the normal class. If you wish to join the normal class for online classes, that is for advanced financial reporting, if you wish to join the normal class, then you can call me on 0722 658875. If you wish to join the normal class, then you can call 0722 658875. We shall talk, and then from there we shall see how you can join the normal class. I'm talking to the new students who are today joining for free, and therefore if they wish to join the normal class, then you can call me on that 0722 658875. Good. At the same time, whether you are new or old students, if you have not subscribed, please subscribe by clicking that subscription button there. You can even click the notification bell so that you are notified anytime we post new videos into the YouTube for free. Whatever videos we post for free, you will be notified. Good. So let's now continue. Now let's continue. Listen to this now. Let me now continue. So I was saying that normally the accounting profit and the taxable profit normally are not the same. The two profits are not the same. I've told you what is the accounting profit. I've told you accounting profit is that profit which is based on the normal accounting principles and concepts. Listen, I've told you taxable profit is that profit on which tax will be based on for tax purposes. I've told you, how do we normally compute what we call the taxable profit? You take the accounting profit, add back all the disallowable expenses, and you minus all the allowable expenses. I've given you a few examples of disallowable expenses, one of them being depreciation, provision for bad debts, donations. Maybe let me talk about another one for the sake of getting it clearly. Let me talk about another example of a disallowable expense. Let me talk about another example of a disallowable expense. But for me to talk about it, let me take you back to your financial accounting lessons. When you did financial accounting, you did company accounts as a topic. And in that topic of company accounts, whenever the examiner wants you to prepare, whenever he wanted you to prepare an income statement, normally he will give you a trial balance. Let us assume in that trial balance, he gives you the following: 10% debentures, and the amount is 500. Assuming that's what you have, together with the many other items. That's what he has given you as part of the trial balance. Now listen, if he has given you as part of the trial balance, and you are told to prepare an income statement for this company. If you are told to prepare an income statement for this company, the question is this: in that profit and loss, were you charging interest? In this trial balance, you are given 10% debentures amounting to 500. Nothing else in the trial balance. Then you are told to prepare an income statement. My question is, were you charging interest on the debenture in the income statement? Were you charging interest on debenture in the income statement? Now listen. The answer is, I'm trying to move on. The answer is yes, you will still charge. Listen, in accounting, there is a concept we normally call accrual concept. There is a concept we normally call accrual concept. What does the concept state? The concept states that costs should be recognized when they are incurred, but not when money is paid. Costs are recognized when they are incurred, but not when money is paid. Listen. So if your company has a 10% debenture, whether you have paid interest to the debenture holders or not, you were supposed to have paid them this year. You were supposed to have paid them their interest this year. How much? Every year, you're supposed to pay them at a rate of 10% on the value of the debenture, which is 500. So every year, you're supposed to pay them 50,000 shillings. That's what you're supposed to pay them. Whether you have paid them or not, you should recognize the expense when it was incurred, but not when money was paid. So have you incurred that expense? Yes. Have you paid it? According to this trial balance, I can't see anything concerning interest. I can't see anything in the trial balance concerning interest. So automatically it means you have not paid. But that does not mean you are not going to recognize interest. In your income statement, you will still recognize interest of how much? 50. Listen, in the balance sheet of this company, you will now argue by saying, as a company, do I owe the debenture holders anything concerning interest? Do I owe them anything for interest? The answer is yes. I'm supposed to have paid them 50, but I've not paid them. According to the trial balance, I've not paid them. Therefore, that same 50 will become the charge for the year, and at the same time, it will become the liability by the end of the year. So among your current liabilities, there you will have what we call interest owing of 50,000. interest owing of 50,000. That's what we are saying, that you recognized this expense on accrual basis. On accrual basis. Now listen to my point now. Suppose the question tells you that for tax purposes, interest is recognized on cash basis. For tax purposes, if the question tells you interest is recognized for tax purposes on cash basis, listen now. When will the taxman recognize that 50 as an expense? He will recognize it in the year it will be paid. In the year it is paid. When will you pay it as a business? Obvious, not this year. You will pay it next year. That's why you are taking it to the balance sheet. That's why you are taking it to the balance sheet as a current liability, meaning that it will be paid in the following year. Now listen to this point. This year, you as a businessman, you recognized an expense called interest in the P&L account. But had you paid it? No. So when you make a profit of 800, will the taxman tax you on that 800? The answer is no. Why? Because according to him, you have recognized an expense of 50 in the income statement, which according to him, you should not have recognized it. According to the taxman, he says you should recognize it in the following year when you are paid. But the rules of accounting says you recognize it on accrual basis, which is okay. But for tax purposes, it should be recognized on cash basis, meaning when it is paid. So this year, you have something in the income statement. Listen, as a company, you have something in the income statement which according to the taxman, you should not have it. And that's what? The interest on debenture. It could be interest on loan or interest on debenture. You have recognized it on accrual basis for purpose of accounting. So when I give him the 800, what will he tell me about my expenses? He will tell me my expenses are overcasted. Because I've included another expense called interest. So he will tell me my expenses are overcasted. When expenses are overcasted, automatically profit is undercasted. So what the taxman will do, he will take my 800 and he will add back that interest on debenture. So to him, whatever I recognized it this year, it is a disallowable expense. It is a disallowable expense. Good. So I've given you an example there of an expense. Listen, of an expense which you as a businessman, you are recognizing it in one period this year for accounting purposes. But for tax purposes, you will recognize it in the following year in a different period. But as far as for tax for this year is concerned, you will reject my 50 and consider it as disallowable. Are you there? Good. Now listen. I've told you taxable profit is the profit on which tax will be based on for tax purposes. Listen. That tax which you are supposed to pay on that taxable profit, that tax is what we call the current tax. So when the examiner tells you to compute current tax, he is asking you to first calculate what we are calling the taxable profit. Once you get the taxable profit, to compute the current tax, if the tax rate is 30%, you will take 30% of that on that profit, whichever the profit you have calculated. So that's how you compute one form of tax, which we normally call the current tax. Some questions will call it corporation tax or current tax. That is one form of tax. We have not touched yet. We have not touched yet how to compute deferred tax. Our topic is accounting for deferred tax. But some questions start by asking you to compute what we are calling the current tax. And to compute current tax, I've said, first calculate the taxable profit. Once you calculate the taxable profit, it is on that profit that current tax will be computed. It will be in that profit that the profit on the tax will be based on for tax purposes. Good. So before we continue, let's put down something that we have already said. Let's put down something on what we have already said. So put down the topic, accounting for deferred tax. Accounting for deferred tax. That is the topic, accounting for deferred tax. Accounting for deferred tax. Then you say this. From an accountant's point of view, there are two distinct profit figures. From an accountant's point of view, there are two distinct profit figures. From an accountant's point of view, there are two distinct profit figures. There are two distinct profit figures. Number one, accounting profit. Accounting profit. Accounting profit, then you put a dash. Accounting profit, then you put a dash. This is the profit, accounting profit. Then you say this. This is the profit. This is the profit which is based on, this is the profit which is based on the normal accounting principles and concepts. This is the profit which is based on the normal accounting principles and concepts. This is the profit that is based on the normal accounting principles and concepts. Stop. Stop. Continue. It is the profit. It is the profit that is reported. It is the profit that is reported to the shareholders. It is the profit that is reported to the shareholders. Good. Number two. Number two, taxable profit. Taxable profit. Taxable profit. And you say this. This is the profit. This is the profit on which tax will be based on. This is the profit on which tax will be based on for tax purposes. This is the profit on which tax will be based on for tax purposes. This is the profit on which tax will be based on for tax purposes. i.e., it is the profit, i.e., it is the profit that is used. It is the profit that is used to compute. It is the profit that is used to compute the amount of the current tax. It is the profit that is used to compute the amount of the current tax. Another paragraph. The amount of the taxable profit, the amount of the taxable profit, the amount of the taxable profit is calculated as follows. The amount of the taxable profit is calculated as follows. Let's do it. So anchukua, put down somewhere, accounting profit, which is normally your profit before tax. That's what I was saying. Whatever it will be, then you add all your disallowables. You add all the disallowable expenses. Let's give a few examples. Depreciation charge, whatever the question will give you, or whatever you calculated the year. The second one we have said is provision for bad debts. Provisions for bad debts, whatever it is. The other one I gave you was donations. That is totally disallowable for, that's totally disallowed for tax purposes. Then I can give the last one, which we have said, interest on debentures. Interest on debenture, where I have told you specifically where you are told that interest is recognized for tax purposes on cash basis. Good. Let me assume those are the only ones. I get the net, push it there, get the total, whatever it is. Then I come and less allowable expenses. I less allowable expenses. Allowable expenses. Now, I want to assume the only one is capital allowance. Capital allowance. Let me deduct direct, get whatever you are getting, and that becomes the taxable profit. That becomes the taxable profit. Then, once you are through, you can say down there, current tax equals to, current tax equals to tax rate times whatever is the taxable profit. That's how you compute the current tax. Take the tax rate, you multiply by whatever you have calculated as the taxable profit, as the taxable profit. Good. So finish. Now I develop the topic. Now you know how to compute the current tax. You compute first the taxable profit. Once you compute the taxable profit, it is that profit that you will base on to compute the current tax. Good. So finish now. We want to move on. We want to move on now. Okay. I hope you're through. I want to develop the topic now. I hope you're through now. Now, listen carefully. Now we want to introduce, listen carefully, I want to introduce the concept of deferred tax. The concept of deferred tax. But before I introduce that concept, listen, we have said, what are the causes of the differences between the accounting profit and the taxable profit? What are the causes? I've only given you a few examples. Listen, you have done the subject or the subject of taxation. And so you all know that there are many causes of why the accounting profit is normally not the same as the taxable profit. There are many allowables, many disallowables. I've only given you a few examples. But if I am to ask you to give me others, of course you know, because you have done taxation. But for now, let me assume we know. Get my point there? I'm assuming now you know the causes of the differences between the accounting profit and the taxable profit. I've only listed a few, but you know more than I do because you have done taxation. Now listen. All those causes, all of them, whether allowable or disallowable, all the causes of the differences between the accounting profit and the taxable profit, all those causes, there are too many according to the income tax. Somebody saying something? Yes, the profit, normally we use profit before tax. Somebody is asking, because that is the profit you present to the taxman to tax you. You normally present a profit called profit before tax. Okay? But your profit, you as a business, your profit is what we call the accounting profit. Whatever your profit, according to your rules, that's what we call the accounting profit. Are you there, George? You're asking whether we use profit after tax or profit. we normally use profit before tax. Okay? We normally use the profit before tax, because that's what you want to be taxed on. Okay, good. Now listen. I was saying, of the many courses, if I can remember, when I was doing this subject called tax, we were told that there's a long list of the disallowable expense, about 30 items, according to the Income Tax Act, and so many others disallowables according to the same Income Tax Act. You know them. But I'm saying this, all those courses can be classified. All the courses of the difference between the accounting profit and the taxable profit, all of them can be classified into two categories. The courses of the differences between the accounting profit and the taxable profit, all of them can be classified into two. There is one category of the courses we normally call the timing differences. The timing differences. Some books will call it temporary differences. That's one course. There are some courses we can put all of them together and say they are classified as timing differences. Then we have another category, we call it permanent differences. Permanent differences. Now, listen. I gave you an example of interest. And I told you, if for tax purposes, the taxman recognizes it on cash basis, while you as a businessman, you recognized it on accrual basis. So listen, both of us, that means the businessman and the taxman, both of them will recognize the same 50 interest. But the only difference is the timing. That this year I recognize 50 as an expense, taxman refused it. Next year when I shall pay that 50, that is the time the taxman will say that he will recognize it as an expense. Don't forget, me next year I'm not going to recognize it. I've already paid, charged it this year in my P&L account. Next year I'm not going to charge. I will only have paid. I'll pay it next year, but I'm not going to recognize it in my P&L account. No. Now listen. So that kind of a cost between the profit this year, according to me as a business, and the profit according to the taxman this year, that kind of a cost is what we classify as a timing difference. Meaning, it's an item that is recognized in the income statement in one period. And it is that period which is different from the period in which it will be recognized for tax purposes. It's an item in the income statement in a period, an item that is in the income statement in a period different from the period in which it will be recognized for tax purposes. That kind of a cost, we classify it as a timing or a temporary difference. Now listen. Suppose you bought a motor vehicle at a cost of 1 million. And your policy as a company is to depreciate it over its useful life of 5 years. So it means every year you will be depreciating your asset at 200,000 every year. For tax purposes, the taxman could give you a wear and tear allowance at the rate of 25%. So at 25%, he will be charging capital allowance of 250 every year. Now listen, both of us, that means the businessman and the taxman, both of us will still charge 1 million. But me, I'll depreciate my 1 million over a period of 5 years. But the taxman will depreciate the same 1 million, but over a period of how many years? 4 years. At 25% every year, that will take him only 4 years. Okay? Listen, I have said, both of us are still recognizing the 1 million. But the only difference is the timing. The only difference is the timing. While I take 5 years to recognize the 1 million as an expense, the taxman takes 4 years to recognize it as an expense. That kind of a cost again is what we are classifying as a timing difference. Okay? Now listen again. Come to donation. I gave a donation to a political party this year. As a businessman, I charged it in my income statement. The question is, will the taxman ever recognize it as an expense? No. Of course, he will reject it now. But what about in the future? Will he tell me that he will recognize that donation in the future? No. So there is an item that is in the income statement this year, but it is totally disallowable for tax purposes, not even in the future. So that kind of a cost, why the two profits are differing, that kind of a cost, we classify it as a permanent difference. An item that is in the income statement, but which is totally disallowable for tax purposes, not even in the future. That is what we are saying. So we are saying, why is the accounting profit different from the taxable profit? The cause of why the two profits differ is either because of the timing difference or the permanent difference. I've told you timing difference are those items that appear in the income statement in a period different from the period in which they will be recognized for tax purposes. I've also said permanent differences are those items which appear in the income statement but which are totally disallowable for tax purposes, not even in the future. Good. Now, before I go now to the deferred tax, because I'm introducing it now, let's put down that information. Let's put down that information. So, andika another paragraph. The following, another paragraph, the following are the reasons why, the accounting profit may differ from the taxable profit. The following are the reasons why the accounting profit may differ from the taxable profit. The following are the reasons why the accounting profit may differ from the taxable profit. Number one, timing / temporary differences. Timing / temporary differences. Timing / temporary differences. Timing / temporary differences. Then you say this, put a dash. Put a dash. These are items in the income statement. These are items in the income statement in a period. These are items in the income statement in a period different from. These are items in the income statement in a period different from the period. Different from the period in which they are recognized for tax purposes. These are items in the income statement in a period different from the period in which they are recognized for tax purposes. E.g., capital allowances versus depreciation. e.g. capital allowances versus depreciation, comma, capital allowances versus depreciation, comma, then you say this, interest on debenture, stroke loan, interest on debenture, stroke loan, interest stroke debenture, interest on debenture, stroke loan, which is recognized, interest on loan or interest on debenture, stroke loan, which is recognized on accrual basis, in the income statement, which is recognized on accrual basis in the income statement, which is recognized on accrual basis in the income statement, but on cash basis for tax purposes. 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 Good. Number two, another reason why the two profits are not the same, permanent differences. Two permanent differences. Permanent differences. Then you say this. These are items in the income statement. These are items in the income statement. These are items in the income statement which are totally disallowable for tax purposes. These are items in the income statement which are totally disallowable for tax purposes. i.e., they are not recognized. They are not recognized for tax purposes even in the future. They are not recognized, or they will not, put it that way, they will not be recognized, i.e., they will not be recognized for tax purposes even in the future. Even in the future. Even in the future. Not be recognized for tax purposes even in the future. E.g., donations. E.g., donations. Good. E.g., donations. E.g., donations. Then you say this, another paragraph. Deferred tax. Another paragraph. Deferred tax arise. Deferred tax arise due to the existence. Deferred tax arise due to the existence of the timing differences. Deferred tax arise due to the existence of the timing differences. Deferred tax arise due to the existence of the timing differences. Will you stop? Then you say this. Permanent differences. Permanent differences. Permanent differences. Permanent differences do not give rise to. Permanent differences do not give rise to deferred tax. Permanent differences do not give rise to deferred tax. Good. I've put down that statement, but I've not explained it. I've only said that deferred tax arise due to the existence of the timing differences. I've said permanent differences do not cause deferred tax. So with that, I want now to demonstrate. Listen, I want to demonstrate now how does the timing difference create deferred tax. Allow me now to do a small illustration, through an illustration, how deferred tax comes about. Okay, so now give me time to do a small illustration to develop the concept of deferred tax. Now, let me assume that as a businessman, this year you made a profit of 800,000. You bought a machine at a cost of 1 million. Your policy is to depreciate that machine over its useful life of 5 years. For purpose of tax, the taxman gives you a capital allowance on the same machine at the rate of 25%. So while you will be charging depreciation of 200, 1 million divided by 5 years is 200. The taxman will not be recognizing your 200 depreciation. He will be recognizing his capital allowance of how much? 250 every year. Now listen. So when you gave the taxman this profit of 800, according to you as a businessman, let us assume the tax rate is 30%. You thought you will be required. Listen, you thought as a businessman, you thought you will be required to pay tax of how much? 240. 30% of 800 is 240. Okay? That's what you thought you will be required to pay. But when you gave the taxman that 800, what did the taxman do? He took your 800, he added back your disallowable, which is called what? Depreciation. He does not recognize your depreciation. How much is it? 200. He got 1,000. Then he gives you a capital allowance at the rate of 25%. 25% on 1 million, he gave you a capital allowance of 250. So according to the taxman, he is saying you will pay tax on how much? That means what is the taxable profit? 750. Okay? So according to the taxman, you should pay tax of how much? At 30%. Let me do that calculation. What is 30% of 750? The taxman will require I pay him tax of how much? That is 30% of 750. He will require I pay him tax of 225. Okay? That's what he will require I pay. Listen carefully. Suppose in the second year, the same thing happened. I made a profit of 800. Again, I thought I'll be required to pay 240. But the taxman said, no, I'm not going to pay on 800. So he took my 800 again, added back my depreciation of 200. He got 1,000. He gave me a capital allowance of 250. He said I pay tax on 750. At 30% again, that comes to 225. Third year, I want to assume the same thing happened. I made a profit of 800. I thought I should pay tax of 240. When I gave him the 800, he said, no, you will not tax me on 800. He added back my depreciation, got 1,000. He gave me a capital allowance of 250, got a taxable profit of 750. At 30% again, he told me to pay him 225. Fourth year, let me assume the same thing happened. The fourth year, I made a profit of 800. I thought I'll pay tax of 240. He told me, no, you will not tax me on 800. Took my 800, added back my depreciation of 200, got 1,000. He gave me a capital allowance of 250. Then he told me again, pay tax on 750. At 30%, I will pay him 225. Good. Final year, That is the 5th year. I made a profit of 800. I thought I'll pay 240, but the taxman told me no. You are going to pay on 800, not on 800. He added back my depreciation of 200. He got 1,000. Now listen carefully here. In the 5th year, will the taxman give me a capital allowance? No. Why? Because if he was giving me capital allowance of 250 every year, by the end of the 4th year, he will have already fully depreciated his asset. So in the 5th year, he's not going to give me a capital allowance at all. So in that 5th year, he will require I pay tax on 1,000. At 30%, he will require I pay 300. Okay, good. Now look at it this way. I want to look at the 5-year period as a single period. I thought I'll pay 240 for 5 years. Cumulatively, for those 5 years, I thought I'll pay tax of how much? What is 240 times 5? 240 times 5, that comes to 1.2. That's what I thought I'll pay tax. But the taxman told me what? No, you're not going to pay 240. He told me I'll pay him 225. And I paid him whatever he wanted. 2nd year, 225. 3rd year, 225. 4th year, 225. I paid him whatever he wanted. 5th year, I pay him 300. So for those 5 years again, cumulatively, what does it amount to? It will be 225 times 4. 225 times 4 plus 300. That comes to another 1,200 again. Okay, that's another 1,200. Listen, so over the 5-year period, the position looks to be the same in the long run. Okay, another way, you can also look at it this way. Well, I thought I'll pay tax on 800. For those 5 years, I thought I'll pay tax on a total profit of how much? 800 times 5. That's about 4,000. The taxman said, no, you're not going to pay on 800. No, you will pay on how much? 750, and 1,000. How much cumulative? That is 750 times 4. Times 4 plus 1,000. So he requires again that I pay tax on a profit of how much? 4,000. Listen. So again, the position looks to be the same in the long run. Now, let's go 1 year after the other. We have seen, listen, we have seen that in the long run, the position looks to be the same. But if I look at the position now per year, I thought, now listen carefully, I thought as a businessman, I'll be required to pay 240. But the taxman told me, no, I'm not going to pay him 240. He told me to pay him 225 down here. And I paid him whatever he wanted. But there's a difference between mine, listen carefully now, there's a difference between mine and his. I thought I'll pay 240, but he told me to pay him 225. There's a difference of 15. The question is this now, listen. There's that amount of tax of 15, which the taxman does not want me to pay. I thought I should pay it, but the taxman said no. The question is this now, listen. Does it mean that I'm not going to pay this 15? I thought I should pay 240, but the taxman told me to pay him 225. Does it mean I'm not going to pay this 15? The answer is no. Listen carefully. The answer is no. A time will come when you will be required to pay that 15. You can see, for example, in the 5th year, while I thought I'll pay tax of 240, the taxman will tell me to pay tax of 300. So it is obvious a time will come when I'll be required to pay more taxes. This year, first year, I thought I'll pay 240, but the taxman told me to pay him 225. So what do I do with this tax of 15? Listen, it is therefore prudent that you as a businessman, you defer paying that 15 until a later date. You defer. Meaning, create a liability now of that 15 to be paid in the future. Create that liability now to be paid in the future. So you as a businessman, you will open an account called deferred tax. I want to create a liability now to be paid in the future. We all know a liability is always a credit balance. So to create a liability, I'll have to come and credit this account, which means in year 1, I'm going to debit P&L account by that 15, and I'm going to credit deferred tax. Then I close my books by end of year 1 by carrying down the balance. That is 15. I bring down the balance by the beginning of year 2, balance brought down, 15. Then I look at the position again in the 2nd year. I thought I'll pay tax of 240, but the taxman told me, no, you will pay him 225 again. So a 2nd year again, I'm required to pay less than I thought. By another how much? 15. Let us just do the thorough, the 3-5 years. In the 4th year, 3rd year, the same, 15. 4th year, 15. Look at the 5th year. Look at the 5th year. While I thought I'll pay tax of 240, the taxman told me I'll pay him tax of 300. There's a difference of how much? 60. Now let's do it. Listen carefully now, year 2. While I thought I'll pay tax of 240, the taxman told me to pay him 225. I paid him. The question is, does it mean that I'm not going to pay this extra 15? According to me, I should have paid it. But does it mean the taxman will never ask me to pay that 15? No. A time will come when you will be required to pay that 15. So you defer paying that. Defer it. Because a time will be required when you will be required to pay. So you create a liability now to be paid in the future. So that 15, you will transfer it again. In the 2nd year, you will transfer it to an account we are calling deferred tax. You will debit P&L account and you credit deferred tax by another how much? 15. Then you carry down the balance by the end of year 2, balance carried down, which looks like how much? 30. Then you bring down the balance by the beginning of year 3, balance brought down, that is 30. 3rd year the same. I knew I should pay 240, but I was required to pay 225. I paid. I am supposed to pay 240. Told me to pay 225. I paid him. Does it mean I'm not going to pay that extra 15? I'll have to pay it. So what do? Defer paying that 15. So create a liability now to be paid in the future. You debit P&L account and you credit deferred tax by 15. Then you carry down the balance by end of year 3. That comes to 45. You bring down the balance by the beginning of year 4. Balance brought down. That is 45. You know the same thing happened in the 4th year. I'm going to pay less. But I thought I should pay more. So what do? I defer. Again, I debit P&L account. I credit deferred tax by end of year 4. Then I come and carry down the balance by end of year 4. Balance carry down. That is 60. Okay. I bring down the balance by the beginning of year 5. Come and see a balance brought down. That is 60. Now listen carefully. In the 5th year, while I thought I'll be required to pay 240, that's what I thought as a businessman. The taxman told me, no, you're not going to pay 240, you're going to pay me 300. That's what we saw. So the question is this, where will I get this extra 60 from? while I thought I'll pay 240, the taxman is now saying pays 300. So the question is, where will I get this 60 from? That extra 60. Listen, it is at this point in time that you will go and recall that 60 from where you kept deferring. Now a time has come for you to recall, or in other words, for you to transfer it from where you deferred it. You kept deferring 15 to the deferred tax, 15 every year to the deferred tax. Now go and transfer from that deferred tax this 60. We are calling it a transfer from deferred tax, or in other words, we are saying go and recall 60 from where you deferred it. So in the 5th year, we don't have a transfer to the deferred tax. Instead, we have a transfer from the deferred tax. So you debit deferred tax because it's a credit and we are transferring from there. You debit deferred tax in the 5th year and you credit P&L account by that 60. So this is a simple illustration of how deferred tax comes about. And it's coming about just because of depreciation and capital allowance. I've used 2 simple examples. I've not complicated many other timing differences. I've only used 2. One is depreciation versus capital allowance. Otherwise, you know there are many other disallowables and there are many other allowables. I've only used 2. One, depreciation, and capital allowance. Good. And those 2, of course, I told you, they are part of the timing differences. Good. So now I hope you have understood how deferred tax comes about. Now let's continue. Now let me continue. Now listen again. This is one approach. This is one approach of computing deferred tax. This way of computing deferred tax is one approach. We call it the profit and loss approach. We call it the profit and loss approach of computing deferred tax. There is another approach of computing deferred tax, and that's what we call the balance sheet, or we also call it valuation approach. Balance sheet stroke valuation approach. And this is the approach that the accounting standard on income tax recommends. The second one, balance sheet approach. Okay? But still the first one is there, the profit and loss, but the accounting standard recommends the use of valuation approach. So let me again demonstrate. Let me demonstrate again how to compute deferred tax using the balance sheet or valuation approach. Now listen. Take it that as a businessman, you bought a machine, or let's say a motor vehicle. Let's use a machine. It costed you 10 million. That machine. You have been depreciating it. By end of this year, you are remaining with a net book value of, let's say, 5 million. Or let's say 4 million. Whichever, doesn't matter. 4 million. That is the net book value of your machine by end of this year. That is what we normally call the carrying amount of your asset. That net book value, we call it the carrying amount of your asset. Now listen again. The same machine, the taxman will be giving you a capital allowance every year. Suppose for him, by end of this year, from the same 10 million, he is now remaining with a balance of 1 million to give you as a capital allowance in the future. You as a businessman, well, may back in a book value of 4 million to depreciate it in the future. From the same 10, you are remaining with 4 book value. That's what you're going to depreciate in future. From the same 10, the taxman has been giving you capital allowance. Capital allowance. and he's remaining with a balance of 1 million to give you as capital allowance in the future. Now, listen, the amount at which, or the amount on which tax will be based on, the amount on which tax will be based on for tax purposes using this approach, which in our case here is 1 million. The taxman does not know you are 4 million, or he will not know you are 4 million depreciation in the future. What he will know is that he will give you a capital allowance of 1 million in the future. The amount on which tax will be based on for tax purposes, that amount we normally refer to it as the tax base. We normally refer to it as the tax base. Now listen. Suppose both of us, that means the businessman and the taxman, suppose they are remaining with only 1 more year to go to fully depreciate this asset. Both of them are remaining with 1 more year to go, which is next year. What will happen next year? Look at it this way. Suppose next year, you as a businessman, you make a profit of 100 million. When you give the taxman, or when you will give him to tax you that 100 million, will he tax you on 100 million? No. He will not tax you on 100 million. What he will do, he will add back your depreciation. Which of course next year you are going to charge how much? 4 million. You have seen. Both of us are remaining with only 1 more year to go. That is the future. So that means he will get 104. Then in that next year, he will give you a capital allowance of how much? 1 million. That's what we have seen. He's remaining with a value of 1 million to give you as capital allowance. Now listen. So in the future, he will require, in the future, we are in the current year, but we are looking at the position in the future. In the future, he will require you pay tax on how much? 103. 103. Listen, while you thought, you as a businessman, while you thought you will pay tax on 100, the taxman will tell you that you're going to pay tax on 103. There's a difference between mine and his by how much? 3 million. If you look at the table I prepared here, if I compare the carrying amount of my asset and its tax base, which is 1 million, I am getting again a difference of the same 3 million. Now listen, using this approach of balance sheet or valuation approach, that 3 million, we normally refer to it as what we call the temporary difference. We normally refer to it as the temporary difference. Listen carefully. Going back down here, while I thought I'll be required to pay tax on 100 million next year, the taxman will tell me, no, you will pay tax on 103. Listen. So from the taxman's point of view, he will also require, get here, he will also require that I'll pay tax on also. I'll also pay tax on that 3 million. To the taxman, that 3 million is taxable. While you thought you will pay on 100, the taxman says you will pay on 103. So from the taxman's point of view, that 3 million is still taxable. Listen. So we refer to that kind of, listen, we refer to that kind of a temporary difference, we refer to it as a taxable temporary difference. We normally refer to it as a taxable. You will be required in the future, you will be required to pay tax on that extra 3 million. Listen to me now. So what do you do now as a businessman? You know you will be required to pay tax on that profit of 3 million. what do you do now? Listen. So it is prudent again that you create a liability on the 3 million, create a liability not of 3 million, create a liability on the 3 million. That 3 million is the profit. Create a liability on that 3 million now to be paid in the future. In other words, I'm saying create a deferred tax liability. So we normally say if you have a taxable temporary difference, a taxable temporary difference creates what we call a deferred tax liability. So you know you will be required to pay tax on 3 million also in the future. What is the most prudent thing for you to do? You create a liability now to be paid in the future. Okay? Let's do another illustration. Suppose you have another asset. Let's call it motor vehicle. That motor vehicle costed you whatever, maybe 5 million or 10 million, whatever it is. Again, you have been depreciating it. Suppose you are remaining with 2 million as the book value. For tax purposes, on the same motor vehicle, he has been giving you capital allowance. And by end of this year, the taxman is remaining with a balance of 3 million to give you as capital allowance in the future. Now listen. What will happen in that future? Suppose both of us again are remaining with only 1 more year to go. Suppose next year I make a profit of 100. Will the taxman tax me on that 100 million? No. What he will do, he will tell me, no, he's not going to tax me on 100 million. He will take it and add back my depreciation, which is how much? 2 million. He will get an amount of 102. Then he will give me a capital allowance of 3 million in the future, according to him. So according to the taxman, he will require I pay tax on how much? 99. Listen carefully. While I thought I'll pay tax on 100 million, the taxman will tell me to pay him tax on 99. So our two profits will differ in the future by how much? 1 million. Which means that 1 million again becomes the temporary difference. It becomes the temporary difference. Now listen. That 1 million can also be said to be like this. When I shall give him my profit of 100 million, listen, to arrive at what he wants me to pay tax on, it is the same as saying he will take the 100 million and he will simply deduct 1. He will simply deduct 1 from my profit to arrive at his, which is 99. So that 1 million, we call it a deductible. We call it a deductible temporary difference, in the sense that the taxman will deduct it from your profit. Listen, don't forget, all this we are looking at from the taxman's point of view. What will he argue in the future? The first time, I thought I'll pay tax on 100. He told me I will pay tax on 103. So I knew in the future I'll be required to pay tax on that extra 3 million. So to the taxman, that 3 million was taxable or will be taxable. What do I do now? I create a liability now to be paid in the future. For the second one, I thought I'll pay tax on 100, but he will tell me to pay tax on 99. So to him, he will take my 100 and simply deduct that 1 million to arrive at his 99. So to the taxman, that is deductible. Let's go back to the table pale juu. If you take 3 million at 2 million, which is the carrying amount, you minus 3 million, you get a negative 1. That negative 1, we are calling it a temporary difference. But what kind of a temporary difference? It is a kind of a temporary difference that we call a deductible. A deductible temporary difference. Now listen carefully again. Down here. While I thought I will pay, listen now, while I thought I will pay tax on 100, the taxman will tell me to pay tax on 99 in the future. Meaning what? Meaning, as a businessman, it's like I'm going to save. I am going to save tax on 1 million. I'm going to save tax on that 1 million. In other words, it's like I'm going to recover. I'm going to recover tax on the 1 million. So, in the future, I am going to recover tax on that 1 million. What do I do now in my books for this year? I will do this. Listen, I will create an asset now to be recovered in the future. Told you, on the 1 million, you are going to save tax on the 1 million. Or in other words, you are going to recover tax on the 1 million. So what do you do now? You create an asset now to be recovered in the future. So, if you have what we call a deductible temporary difference, that creates what we call a deferred tax what? Asset. You create an asset now to be recovered in the future. Now, so I hope you are now realizing how the balance sheet approach works. In this balance sheet approach, I'm not through yet, but I'm just trying to highlight. In this balance sheet approach, we normally compare, listen, we normally compare the carrying amount of an asset with its tax base. Then I've also said the difference between the carrying amount of an asset and its tax base, that difference, we call it the temporary difference. I've told you, temporary difference can either be taxable or deductible. We have already shown that if it is a taxable temporary difference, then as a businessman, you will be required to pay more tax in the future. It will be taxable. From the taxman's point of view, it will be taxable. So what do? You create a liability now to be paid in the future. We normally say any taxable temporary difference creates what we call a deferred tax liability. If you have a deductible temporary difference, it means you're going to pay less tax in the future. In other words, you're going to recover some of the tax. So what do? Create an asset now to be recovered in the future. Create an asset now to be recovered in the future. I've said any deductible temporary difference creates what we call a deferred tax asset. We have defined these terms. What's a carrying amount? I've told you. The carrying amount is an amount, the carrying amount of an asset or liability. Sometimes you also have, we shall come across liabilities, balance sheet approach. So we normally say the carrying amount of an asset or liability is the amount at which the asset or liabilities appear in the books. The amount at which an asset or liability appears in the books, that amount, we call it the carrying amount. What is tax base? Tax base is the amount on which tax will be based on for tax purposes. The amount on which tax will be based on for tax purposes, That's what we refer to as the tax base. Okay. Next, the difference between the carrying amount of an asset or liability and its tax base. What is it called? It's called a temporary difference. Okay. And I've told you temporary difference can either be taxable or deductible. Told you if it's a taxable temporary difference, then it creates a deferred tax liability. Why? Because you will be required to pay more taxes in the future. The taxable profit will be 103 down here. That will be the taxable profit. Well, I thought I'll pay tax on 100. So any taxable temporary difference, because it will create more profit to the taxman in the future, then you create liability now. Deductible temporary difference, I have told you, it creates a deferred tax asset. Why? Because you thought you'll pay on 100, taxman will require you pay on 99, so you're going to save tax on 1,000,000. So that means you create an asset now to be recovered in the future. Good. Now, we are not through yet with the balance sheet approach. But maybe for today we can stop there. We pick it up from there next time, where I'm now going through the other balance sheet items. We are not through yet, but I've introduced it. Then we compare the carrying amount with the tax base, carrying amount with the tax base, getting the temporary differences. Now listen. From what I have discussed so far, I have answered so many theory questions from your past papers. More often you're asked some theory questions from here. What's a carrying amount? What's a tax base? What's a temporary difference? What's a taxable temporary difference? What's a deductible temporary? What's a deferred tax liability? What's a deferred tax asset? Those are kind of questions that you may be given as far as theory questions are concerned. What's a carrying amount? What's a tax base? What's a temporary difference? What's a deductible temporary difference? What's a taxable temporary difference? Another time you are told, define what's a deferred tax liability, what's a deferred tax asset, and so on. So next time I'll still go through what I've said, then we complete the other items. Okay? Otherwise, listen, I've told you today we have a new students who are just visiting us for today, but I've told you, please subscribe to my YouTube channel. Please subscribe to my YouTube channel if you have not subscribed. Whether you are an old student or a new student or just today you joined us for free, no problem. Subscribe. If you have not subscribed, please click that subscription button down there so that you will be notified anytime we want to post new videos or we are posting new videos to the YouTube. Of course, my YouTube channel is called CPA Joseph Njuguna. That's the name of the CPA the channel, CPA Joseph Njuguna. Okay, that is it. Good. The other point is, this is Njuguna. The other point I've told you is, if you are interested, especially for the new students who have joined us for free today, if you are interested in joining our online classes, then you can call me on 0722 65 8875. Okay. Today we are doing advanced financial reporting. Listen, those who are new, listen. We normally have either early morning. Classes. Just for the new students, I'm talking to you now, which comes every 5:30 to 7 a.m. on Monday, Wednesday, and Friday. If you choose early morning for advanced financial reporting, for evening, it is every Monday, Wednesday, and Saturday from 8 p.m. to 10 p.m. if you choose evening. If you are not able to join the either of the early morning or evening, you can still buy what you call pre-recorded videos. Talking to the new students, you can buy what we call pre-recorded videos, where you get all the videos at your once, you watch them at your own free time. You watch them at your own free time. Good. Now listen, some of you have friends who are doing financial reporting. Some of you have friends who are doing financial reporting. We also have financial reporting on online basis. So if there are friends you know who are interested in this financial reporting of the intermediate, tell them. Again, classes are every Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. From 8 p.m. to 10 p.m. For all this again, there is pre-recorded for financial reporting. Listen also, some of you could also have friends who are doing financial accounting of the foundation level or the one of ATD. Tell them again, we are offering that financial accounting paper. Okay? Whether pre-recorded, listen, whether pre-recorded or live class, we are charging 4,000. We normally accept payments on installments. If you want to pay on installment, you can still pay on installments. Good. I think I'm through with what I wanted to talk about to the new students who are there for today for free. No problem. We invited you. Otherwise, if you are interested, you can call me on that number 0722 6588. This is 8875. 8875. Otherwise, have a good night. See you next time. Bye for now. See you next time. Now I'll continue from where we have stopped, where we were doing the balance sheet approach of computing the deferred tax. Okay? Otherwise, bye for now. See you. Bye. Okay, good night. See you. Good night to you.